Very good morning, everyone. Guys, I'm not able to hear anyone here. Am I audible?
Yes, ma'am.
For that heads up. Give me a minute, okay? We'll start up with the amendments very soon. Yes, so good morning again. We'll be seeing the amendments. These are primarily applicable for everyone who is writing in May 2021. Okay, interlevel May 2021. These amendments are also common for the November attempt also, but in November attempts, you will be having mode of additions in terms of circulars, which are set henceforth too. We'll be trying and covering up major amendments today. If you have any doubt, you can drop your doubts in the chat box, or you can ask me at the end of the session too. If anything needs to be explained again, you can again ask me to do it at the end of the session. I'll do it. Okay. Okay. So the financial year that is applicable would be previous year 2021. Yes. So 2021 is the applicable year, assessment year 21-22. For that year, these are your tax slabs. So up to 60 years of age of an individual, it is 5%, 2.5 lakhs to 5 lakhs. So up to 2.5 lakhs, there is no tax. 2.5 to 5, it is 5%. 5 to 10 lakhs, 20%. Above 10 lakhs, 30%. The same slab is also for HUF, artificial judicial person, and other AJP and all those things too. If they are of the age 60, more than 60, 60 and above, less than 80, then instead of 2.5, it would be 3 lakhs. And if they are of the age 80 and above, it would be 5 lakhs and above, the taxability would start. So up to 5 lakhs, there is no tax. 5 to 10, it is 20%. Above 10 lakhs, it is 30%. There is no pretty much change here. What has happened is, this is called as the old regime. Now we also have an alternative way of taxing for individual and HUF, which is 115 BAC. Okay, we'll be calling it as 115 back for the easier purpose. So 115 BAC has been introduced now. Every assessee gets a choice to choose between this existing old scheme and to choose from 115 BAC. I'll be seeing 115 BAC or back a little more in detail in some upcoming slides. So for now, I'm just saying about the old regime of taxation or the regular regime of taxation. There is no change here. These rates are the same. I'm just giving a quick revision. This is for the cooperative society up to 10,000. It is 10%. 10,000 to 20,000, it is 20%. Above 20,000, it is 30%. As far as firm is concerned, it is 30%. And for local authorities, also it is 30%. Companies, we have come across different scenarios now. For companies, if the turnover or gross receipts in previous year 18-19, okay, we skip 1 year and go back. So previous year 18-19, if it is less than or equal to 400 crores, then it is 25%, otherwise it is 30%. There are two more alternative taxations that they can opt for. 115BAA, 115BAB. So 115BAA is where they have to let go of certain benefits that they were enjoying earlier. Could be a deduction, could be exemption. We have a list of deductions that the companies would have been enjoying. They have to let go of those deductions and benefits. If they do so, they can opt for 22% of taxation under 115BAA. 115BAB, this is for those companies who are started or who are into the manufacturing process. So they have set up and registered themselves new companies after 1/10/2019. So if they are setting up a manufacturing company after 1/10/2019, in that case, 15% is what will be the tax bracket for them. Surcharge, there is no change. So I've just kept it as a revision. I'll be also sharing up this PPT with you all in the group, WhatsApp group. Rebate also under 87A. Always please remember only resident individuals, only they enjoy the rebate if the income does not exceed 5 lakhs. So the rebate would be least of the following: actual tax payable or 12,500. Please remember in the MCQs, they can confuse you with the residential status. It is only the residents who enjoy rebate, not the non-residents. Okay, and rebate is given before adding any kind of cess. So before adding your higher education cess, rebate is first given, and then on the balance amount, if any, cess will be added. Also, it is not available if the only taxation is long-term capital gain under section 112A. 112A deals with your shares and your equity-oriented funds and stuff like that. So they are taxed at 10% at flat without giving any kind of rebate. So this was what was already existing as per the earlier years. What has happened in residential status? There have been 2 major amendments. Okay, this is very important, and from the exam point of view, a definite question can be expected from this area too. Now, residential status, we earlier knew there were 2, resident, non-resident. 2 changes which have happened is, one, they have added something here, okay? And they have introduced a separate segment called as deemed resident. Please remember, there is no residential status as a deemed resident, but a set of category of people will now be deemed to be resident. They are also to be classified as RNOR only. Okay, so when your question asks about the residential status, you will say that they are deemed to be residents, but the status is RNOR only. Let me explain you what has happened here now. Let's take one by one. If I'm taking the first point about the resident, normally, how do we say a person is a resident? So they should have been in India for a total of 182 days or more during the previous year. That's your first basic condition. At least 182 days they should have been during the previous year in India, or this is either or at least 60 days in the previous year and 365 days in the 4 preceding previous years. This is something you all know, no change as far as this is concerned. So either 182 days if they have stayed in India, they become a resident, or they should have stayed in India for 60 days in the previous year and 365 days in the 4 preceding previous years. So no change as far as this is concerned. What is happening is, in this 182 days condition, the first condition, we had an exemption category. This was the exemption category. That is, we would only check this criteria for this 2 category of people: Indian citizen who is leaving India for employment, and Indian citizen or persons of Indian origin who comes to visit India. So for them, the 60 days and 365 days in 4 preceding previous year category or condition was not applicable at all. We had to only check this one basic condition. The changes come in this zone. So if Indian citizen or person of Indian origin, if they are coming to visit India, here we have a change. and their total income, excluding foreign income, is exceeding 15 lakhs. Then you need to check up another condition too, apart from the first basic condition. Okay, let's understand what is this. First, when we talk about excluding foreign income, it means any income that is arising in India, which is accruing in India, deemed to accrue or arise in India, received in India, or deemed to be received in India. Those four categories. So even if the person is staying outside India, but the business is set up in India or controlled in India, it would be deemed as Indian income only. So only we exclude their foreign income, and we take those, if that income, that is basically other than foreign income, if it is exceeding 15 lakhs, and they happen to be Indian citizen, only Indian citizens, okay, or persons of Indian origin. So basically Indian citizen is what we are looking into. If they are Indian citizens and their income, excluding foreign income, is exceeding 15 lakhs, then for them, we need to see whether they're staying for more than 120 days in the previous year or not. Okay, so we need to check this additional condition. They should have stayed in India for 120 days in the previous year, and for previous years, 365 days in total. So if they satisfy this condition, they become a resident. Again, it's an either or condition. Okay, once they become a resident, we then go into the other two conditions to see if they are an ROR and RNOR. There is no change there. Please remember, this condition was not there earlier. Okay, this condition was not there earlier. We only had 182 days. So now, if they are staying in India for 182 days or more, they are automatically resident. Because they are staying, because of this new amendment, if their stay happens to be in between 120 and 182, now they will also be deemed as resident, or they will also be a resident now. Okay. Please remember, after 182 days, they were already a resident based on the first condition. Because of this second new condition, even if they are staying for 120 days in the previous year and 365 days in the 4 preceding previous years, they would now be a resident. Because it is not fair for them, this category of people who are staying for more than 120 days but less than 182 days, this category of people would be RNOR, resident, not ordinarily resident. Okay. So if their stay is exceeding 120 days, but it is less than 182 days, they would always be RNOR. You need not check any other condition too. If in case their stay is exceeding 182 days, then we go about checking all the other conditions, whether they were resident in 2 out of 10 years or 729 days, 730 days, all those conditions will apply later. If their stay, please remember, for Indian citizens, and the income is exceeding 15 lakhs, if their stay is more than 120 days, they become a resident. But if they are within 182 days, they would be RNOR, and the taxability would be according to that. This is your first major amendment which has happened in the residential status sections. Coming back to the second major amendment, please remember, we earlier had resident, non-resident, and now what they have done is they have deemed certain people to be residents. Okay, this is a new category introduced, whereas certain people, earlier they were not falling under the residential status category, would now be deemed to be the resident. Who are these? Again, focus is on Indian citizen only. Please remember, both of them have this in common. If they are Indian citizen and the income, again, excluding foreign income, is exceeding 15 lakhs, and they are not liable to tax as resident in any other country, they would be deemed to be resident in India. So what used to happen here is, there are many people who were playing with the tax laws, and they happen to be a non-resident in all the countries. Since they were non-residents, not global income used to get taxed, and they were kind of escaping the tax route by using this loophole. So now the government said, in case you have income, excluding foreign income, that is the Indian income is more than 15 lakhs, and you are not paying as resident tax in any other country, for the purpose of Indian taxation, you would be deemed to be a resident. Okay. Here, days criteria, your stay criteria is not at all relevant. It's only that you are not paying tax as a resident in any country. This is the condition which will apply. Please remember, deemed resident is always RNOR, resident, not ordinarily resident. Okay, they will always be RNOR only. So if the category or if the residential status question comes up, you will say they are deemed to be resident, but the residential status is RNOR. Okay, there is no such residential status as deemed resident. Be very clear. Your question can confuse you. In fact, I've taken up one question. Let's do that. Mr. Tejas, an Indian citizen, left India permanently with his wife and 2 children for extending his retail trade business of toys in Canada in the year 2015. From Canada, he is managing his retail business of toys in India. For the purpose of his Indian business, he visits India every year from 1st September to 31st January. His business income is 23.5 lakhs and 18 lakhs from the retail trade business in Canada and in India, respectively, for the financial year 2021. He has no other income during the previous year, 2021. Determine his residential status and the income taxable in the hands of AY 2021. This is an MCQ question, okay, where they have given you 4 options. Will he be a resident, ordinarily resident, and income of 18 and 23.5 lakhs would be taxable? Will he be a non-resident and 18 lakhs from Indian retail trade business would only be taxable? Will he be an RNOR and 18 lakhs from the Indian retail trade business would only be taxable? Or is he a deemed resident and 18 lakhs from the Indian retail business would be taxable? Please give your answers in the chat box. Is it A, B, C, or D? Okay. Every year he's coming from 1st September to 31st January. So he's staying September, October, November, December, and January, right? I have to add 31 more. So 153 days is what he's staying here. So 153 days in the previous year and equal amount of days in the 4 previous years. So 153 into 4, much more than 365. Yeah, so what will be the residential status? Answer fast in the chat box, guys. Very good. Yes. Okay. Now, going by the sections, we have to see what 2 things. Is he staying by? He's staying for more than 120 days in the previous year. Yes. Okay. And more than 365 days in the 4 preceding previous years, but less than 182 days. So he would be a RNOR and 18 lakhs from the Indian retail trade business would be taxable. Where number of days of stay come into criteria, you go by the first amendment. He's also an Indian citizen. Very important, please check whether he's an Indian citizen or not. Only then the new 2 amendments will apply. Yes? Yes, those who have answered C are correct. Those who have answered D, please again check. So I'll be taking up amendments chapter wise. We'll move on to the next chapter, salary. If any of you have any doubt with regard to residential status, you can ping me at the end of the session. Salary amendments, there are a couple of amendments again here. This is with regard to startup. As you all know, startup is something which comes up with this, new idea or new kind of an invention which they want to monetize in terms of business. So in case eligible startup, if they are giving ESOP or employee stock option plans, which is also called as sweat equity, considering they give their sweat to the business. So if eligible startup, if they are giving ESOPs to its employees, then the taxability would be different. Normally, if ESOPs are given to the employees by any company, it is taxed at the exercise of the option. But here, they say it would be taxed in the earliest of the following. We check in 3 categories. First one is after expiry of 48 months, that is 4 years. So after 4 years from the end of the relevant assessment year, which year? The year in was it was allotted. So from the year of allotment, okay, they say take up 4 years. After 4 years expiry, then the ESOP will be taxed. Or if it is sold before such period, so if the sale is made before such period, then it would be taxed. Or in case the assessee ceases to be the employer, if he is no longer the employer of that eligible startup, then in that year, when he is leaving the job or he is not an employee, that year, the ESOP will be taxed in the hands of the employee. It will be taxed as a taxable perquisite only. Please remember, this is only for eligible startups. Okay. Now, why is this come? Normally, when a startup is begin or it started, what happens is they don't have much of valuation. They don't have much of funds. So they give all these ESOPs and retain their employees. Initial days, there is no value also of that particular share. It is only when these shares grow that people will even be able to monetize on the equity which is held by them. So that's why they say extend it up till 4 years, or if you're selling, or if you're no longer the employee in that particular organization. This is your next amendment. Wherever there is employer contribution, please remember, if the employer is contributing, they are not talking about the employee contribution, they are only talking about the employer contribution. If the employer is contributing to recognized provident fund for the employee, to the national pension scheme, and to approved superannuation fund, they ask you to total it up. Okay, they say total it up. If the total amount is exceeding 7.5 lakhs, 7,50,000. If it is exceeding 7,50,000, that excess portion will now be taxed. Say, for example, you total it up. It comes to 9 lakhs. So the difference, which is 1,50,000, this is going to be taxed in the hands of the employee. Okay. Please remember the exemptions which are enjoyed in the relevant sections are still there. So this 12% of the employer contribution in recognized PF or NPS or 10% of that superannuation fund, that is still there. This is an additional condition that has to be now checked. What was happening is because of these contributions, they were somehow enjoying a lot more benefits than what the government was intending them to. So now they said, let's total it up. In case the total is exceeding 7.5 lakhs, that is going to be taxed in the hands of the employee now. It would be taxed as a perquisite again. Okay. So please remember the aggregate employer contribution from recognized provident fund, NPS, and also your superannuation fund. All the three put together, if it is exceeding 7.5 lakhs, the excess amount will be taxed as perquisite. It is every year. So every year you do this exercise, not just total. Okay. Every year we have to do this exercise. Now, so this is one change. Second, what they say is, in case there is any kind of dividend, interest, or some kind of annual accretion that is coming into these accounts, it could be with reference to the same accounts, okay? Your PF, NPS, and superannuation fund. If these accounts, okay, are getting any kind of dividend, interest, or some kind of annual accretion on the excess portion, like for example, in the earlier example, I took up 9 lakhs as the total amount and 7,50,000, they say it is okay. The difference here, 1,50,000. On this excess amount, if you're getting any interest dividend, or any such annual accretion, that will also now be taxed as a perquisite. It will now be included in the total income of the assessee. So not just the contribution, but also the annual accretion on that amount. Only employer contribution, only excess portion. Okay, so only on the employer contributions excess portion, any kind of interest, dividend, or similar accretion is happening, then that will also be taxed as a perquisite now. So these were as far as your salary was concerned. House property, there are no major amendments, or rather there is no amendment at all. In your material given by the ICAI, there is an alternative view given on gross annual value. Okay, so it's an alternative view. What is this? Just understand it. Even if you don't apply it, it is okay, because it is just an alternative view which is given here. So they say normally when you compute your GAV, the first step is you take up your fair market value, standard rent, municipal rent, and you compare that. Okay, so you call that, you take up that rent as the expected rent. And the second thing is your actual rent. Here, when you take up the actual rent, you subtract whatever unrealized rent is there from the actual rent. This is basically actual rent minus unrealized rent. This is what we've been doing so far. And we compare 1 and 2, whichever is higher is what we take as GAV. Okay, this is what we've been doing. Now, an alternative view is given by ICAI. They say your unrealized rent, don't subtract it here. Don't subtract it here. Rather, from the GAV, subtract it here. So unrealized rent is now to be subtracted from the GAV. This is an alternate view. Even if you do in the earlier way, you're absolutely correct. Why is this alternate view given? Is because the income tax returns are permitting deduction in this manner too. Please remember, it is only an alternate view. Even if you are doing up in the earlier ways, it is completely okay. Yes, just don't get confused when you come across this in your material. So this is also an option given. You either subtract your unrealized rent from the actual rent here or from the GAV. That's the option available now. Let's move on to the next, Pgp amendments. So guys, there are a whole bunch of amendments that has happened in Pgp and even otherwise, as far as your considering the budget has come and many circulars have come, and especially considering it was the COVID scenario. So TDS has fully gone for a toss. I'll be taking it up chapter wise. Let's move ahead with Pgp. Earlier in Pgp, we had a section 32AD. So there in this section, if a manufacturing entity is having any kind of a unit in notified backward areas of West Bengal, Andhra Pradesh, Bihar, and Telangana, they enjoyed additional deduction. Okay, a deduction was given under section 32AD. This is only till 31st March 2020. So from now on, it will not be applicable. So you don't even have to get into those details. Please remember, if you have learned something like 32AD, this is no longer applicable. So out of practice, when you hear about these 4 states, you have a habit of giving deductions and additional depreciation. It is no longer there. Yes? The ones who have no idea about 32AD, it's best to be that way itself. Additional depreciation was also given to these 4 states at the rate of 35%. Now it is uniform 20% on machinery for every other state also. So this additional depreciation is no longer there. It is at a uniform rate at 20%. Please remember, it is only on plant and machinery, not on any other asset. This was only till 31st March 2020. I'll give a small example here to explain what I've mentioned in note first. Say, for example, in this previous year, 1920, okay, on 1st March 2020, a machinery of 10 lakhs was put to use. Normally, we give depreciation at 15%, okay? And assuming it happened to be in the state of Telangana. So in the previous year, 1920, you would have given additional depreciation at 35%. But since it is put to use less than 180 days, less than 180 days, you would have given only half of it. So 50% of this, or rather 17.5% of depreciation would be available in the previous year, 1920. And they say the remaining you can claim in the next year, 2021. So please remember that additional depreciation, which is on the assets put to use for less than 180 days in the previous year, 1920, will still be allowed at 17.5. This is the remaining 50% of 35%. Okay, this is not a different rate. Don't get confused here. This is 50% of 35%, which they can enjoy on the assets which were put to use in the previous year, 1920, but for less than 180 days. Okay. You can again expect questions in MCQ here. Just to confuse you with the rates of 20, 17.5 and 35%, they can ask you questions even here and see how much you're providing in the current year. Moving on to the next one. Now, before I even go into that, automobile industry had gone through a certain kind of a recession in this particular phase, okay? 2019-20, they were not doing very good. It was kind of a low down for them. So they approached the government, and in order to encourage people to buy more of cars and motor vehicles, they gave enhanced rate of depreciation. So they said anyone who is buying car, okay, car other than for running them on hire, if your purchase date and if you're putting to use before 31st March 2020, so if you're buying between 23rd August 2019 to 31st March 2020, if this is the date of your procurement and put to use period, you will enjoy depreciation at an enhanced rate of 30%. Normally it is 15, but because you're buying in this particular date bracket or period, it would be 30%. And also if it is bought on hire business, so if bus, lorry, taxis, if they are bought on hire business, it would be 45%. It was 30, normally it is 30, but if you're procuring them at this period, it would be 45%. So in the financial year 1920 or the previous year 1920, we adopted these rates. For the previous year 2021, these assets would continue enjoying the enhanced rates of 30 and 45%. Please remember, if a car is bought in this period, even for the previous year 2021 and henceforth, they would still get depreciation at these higher rates. But if any car or vehicle is purchased in the next period, that is from 1/4/2020 to 31st March 2021, then they would be getting the regular rates of 15 and 30% only. Okay, this would be treated as a different block under motor vehicle category. This is one of the amendments. The other amendments are such. So section 35, which talks about your scientific expenses. So expenditure on scientific research, earlier we had them in different categories. We still have those categories. Now, if you all can recall, we used to give some categories as 125%, some categories 150%, and so on. Now, for this year, they have made it very simple. They say no weighted deduction. Basically, if you have spent 1 lakh, take a deduction of 1 lakh only. So 100% of the amount spent would be given as deduction. There would be no enhanced or weighted deduction henceforth. Okay, so on section 35, you have same amount of deduction, that is 100%, no enhanced. So if you had earlier been studying about this enhanced rate of depreciation, please change that, unlearn that, and bring it to 100%. Basically, No weighted deduction there. The next section is 35 AD, where deduction would be given for certain specified business. So all those businesses is like warehouse, cold storage, hotel, and all that belong to this category. This is now made optional to the assessee. Why is it made optional? If you recall, I started the session by saying you something like 115 back has been introduced. So if a person is choosing 115 back, they have to let go of many deductions and exemptions that they are enjoying. Earlier, it was mandatory that you have to choose 35 AD. You have to take that deduction. But now it has become optional so that they can tax plan in any other way that they like to. So if they want to choose 115 back, they can use that. Or if they want to do any other tax planning, they've also given that option to the assessee. This is only made optional now. 35 AD was amortization of preliminary expenses. The only addition that has happened here is that in the first year, in the first year of claiming of expenses, they have to now furnish audit report. Okay, in the first year where they are claiming these preliminary expenses, they have to now furnish audit report within the due date specified. The due dates which have been specified is now changed. Let's understand that. What has happened here? Wherever the due date of audit was mentioned in any of the sections in PGBP or otherwise, please remember the dates have now changed. It is now 1 month prior to due date of furnishing of return. So due date of filing of return is 31st October, but due date to furnish audit report is 30th September. 1 month before the due date of filing your return of income, this has to be submitted. So audit report has to be furnished at the max by 30th of September, but return can be filed by 31st October. This is what the section says. Practically what we do is we furnish return and also file the audit report together. This was more useful for those, like for example, if the tax, if a partnership firm has to get itself audited, if that comes under the tax audit purview, the partners were not having sufficient time to now file their returns. So now they get an extended period too. 31st October becomes the due date of filing because the audit happens by 30th September itself. They get enough and more time to file their returns as well. The next amendment which has happened is in the tax audit limit. Now here, the new criteria of 5 crore is introduced. So when this was being said in the budget that now the tax audit report or the tax audit limit would be 5 crores, everyone was so happy, that it is 5 crores. But it came with these terms and conditions, which is very difficult to comply by, going by the scenario which is actually existing. Let's understand what is this. Normally, 1 crore is the tax audit limit. Okay, so normally if anyone, this is only for business, not for profession. So if anyone has their turnover or gross receipts of 1 crore and above, they would have to go for tax audit. But till 2 crores, they can opt for 44AD. That is, if their turnover is still 2 crores and they are opting for 44AD, they need not get their books audited. And if they are fulfilling these two conditions, if their turnover is still 5 crores, but if they fulfill these two conditions, they need not get their books audited. What are these two conditions? They say, total up all your cash receipts. If it is less than 5% of total receipts in the relevant previous year, you need not get your books audited. And total up all your cash payments, including your expenses. So all your purchases, all your payments, all your expenses, total it up. And if it is less than 5% of total payments, cash payment should not exceed 5% of total payments. If you fulfill these conditions, then if your turnover is up to 5 crores, you need not get your books audited. The whole purpose for getting audit is that you are declaring yourself correctly or not. Since everything is now being routed through bank, if you're opting for this particular, if you're fulfilling this condition, it means you're having all your transaction in the banking route. So they have given this enhanced limit of 5 crores. Yes. So please remember, it is 5 crores of tax audit limit in case you're opting for making all the cash payments and cash receipts by banking system except for 5%. It becomes 2 crores in case you're opting for 44 AD, and it is 1 crore otherwise in all the other cases. Aggregate and total is the same. Okay, so wherever you use the word aggregate and the total, it is the same. Total of, basically, suppose you're having 5,000 payment on one day, 10,000 payment of one day, and 15,000 payment of one day. They ask you to aggregate it or total it up. Yes? This is with regard to your PGBP. Guys, be very careful when it comes to MCQs. When amendments itself, okay, amendments itself, around 15 to 20% of your questions in the exam will be related to amendments. It's very important you are knowing about them thoroughly. There is nothing you can skip here, not even a single one. It can be a part of a big question too. Let's move on to the next chapter, capital gains. Here, let me recall the earlier provision. If any property is acquired before 1/4/2001, I'm talking about immovable property, land and building. If anything is acquired before 1/4/2001, the assessee used to get a choice. Either take up the actual cost or fair market value. Okay, so either take up the actual cost or fair market value as on 1/4/2001. So the assessee used to get an option. They used to either choose the actual cost or fair market value for the purpose of cost of acquisition. Obviously, they will choose whichever is higher. Now, what has happened is, they say this amount will not exceed the stamp duty value as on 1/4/2001 wherever available. If it's not available, we stick to the same old provision. But if it is available, that also has to be compared. I'll give an example. Say, for example, cost of the land came to around 10 lakhs. Fair market value as on 1/4/2001 happened to be 12 lakhs. And the registration value or stamp duty value as on 1/4/2001 happened to be 11 lakhs. So earlier provision, you would choose obviously 12 lakhs. Okay. But because of this amendment, you have to restrict yourself to 11 lakhs. You cannot go more than the stamp duty value. This is the amendment which has come here. Slum sale, that is 50B talks about your slum sale. If you remember, slum sale is the entire unit is being sold as such, with the building, land, machinery, everything. Everything is sold as such. Here, reporting of CA or report by CA is now required within the due date. So I said you, wherever the specified due date is mentioned, it is now 30th September, which is 1 month prior to the due date of filing of return. So only about the due date, this amendment was taken, okay? Please remember, wherever you have the due date mentioned for furnishing audit report, it is now 30th September, 1 month prior to the due date of filing of return. Earlier, both were same. Now there is a 1 month gap. Okay. This is again a very important question. Can be asked from MCQ point of view. There are 2 amendments here, okay? This is 1 and this is 2. I'm taking up 2 sections here. 50C with regard to your capital asset and 43CA stock in trade. This is about PGBP. Okay, so if an asset is sold as a capital asset, 50C would apply. If it is sold as a stock in trade, this is basically for land and building. If it is sold as a stock in trade for builders, then 43CA used to apply. What did it say here? They say compare the actual cost or the actual consideration. If you're selling it, what is the consideration that you're getting? Actual consideration and stamp duty value. Compare it. In case your stamp duty value is high, then stamp duty value would be deemed to be the full value of consideration. Earlier, they gave a cushion of 5%. So if the difference used to be 5%, it was okay. Now they have increased this cushion and they have said up to 10% it is okay. That means they say take up your actual consideration, the receipts or your sale value that you have generated. Increase it by 10%, or rather, in other words, take 110% of that. And that you compare with the stamp duty value. If your stamp duty value is still more, then stamp duty value will be considered as the full value of consideration. I'll give you an example. Say, for example, 10 lakhs is the consideration that you have got. Okay. Stamp duty value is 12 lakhs. Okay. For the particular property, 10 lakhs is the actual consideration. Stamp duty value is 12 lakhs. They say increase this by 10%. So 10% would be 1 lakh. This becomes 11 lakhs. And they say now you give a comparison. Is your stamp duty value still high? Yes, it is still high. So 12 lakhs is still higher than 11 lakhs. So in that case, stamp duty value will be taken as the deemed value for consideration. Let me take up another example. If this is your actual consideration and stamp duty value happens to be 10,50,000. Okay. So actual consideration is 10 lakhs. Stamp duty value is 10,50,000. They say increase 10% of the value, 11 lakhs. Is it more than the stamp duty value? Now, no. So in this case, we will stick with what you have said. So 10 lakhs would be the consideration itself. Stamp duty value will not be taken as the full value of consideration. Why? Because it is less than because the difference is less than 10%. Earlier, this was 5%. That quotient is now being enhanced to 10%. Okay, for both these sections, this value, the same calculation used to apply. Another place, another reason why I have added the next section here is this was also earlier 5%. Now it's become 10%. So earlier, if any kind of property was given for inadequate consideration, say for example, the value of the property, fair market value of the property was 10 lakhs, but that was given for say 5 lakhs. So remaining used to be taxed as gift under 56(2)(10). Okay, so it was taxed as gift for inadequate consideration. Even now it is the same, but now they say take up the stamp duty value and the actual consideration and compare higher of 50,000 or 10% of the consideration. So if this difference, you compare if it is either 50,000 or more than 10% higher of the two, then the difference, whatever is the difference, will be taxed as income from other sources as gift under this section. So earlier this condition, even here was 5%, even this is now become 10%. Here also we had a cushion of 5%. Okay, in 50C and 43C, we had a cushion of 5%. Now it is 110%. Please be very careful with regard to MCQs here, an area where you can get questions, especially with regard to these two sections. Let's move on to the next chapter, which is income from other sources. So income from other sources, the biggest amendment that has come is dividend. Okay, again, please expect a question in dividend. For sure, it is going to come. Dividend is now fully taxable. So for these many years, we've been studying dividend is exempt. So now dividend becomes fully taxable. Earlier, it was exempt. Why? Because the companies were paying dividend distribution tax. Since now it is fully taxable in the hands of the assessee, the companies need not pay any kind of dividend distribution tax, which means the treatment which foreign dividend and Indian dividend were getting is now same. So even if a domestic company is giving dividend or foreign company is giving dividend, it is going to be taxable in the hands of the assessee. Earlier, we used to have a section 1034 that is basically no longer there. Even mutual fund dividend is also taxable. So dividend, if it is coming from these funds, they would also be taxable. This is as far as your dividend taxability is concerned. Deemed dividend is also taxable, yes. Deemed dividend is also 222E, that is also going to be taxable. So all kinds of dividend is now taxable. Keep it simple. Deemed dividend, any kind of dividend is taxable, okay? With regard to dividend, there are so many changes that has come. First is deduction. They say only interest you can claim as deduction. So if you're having dividend income, from that you can reduce interest. So basically, if you have taken any loan and invested in equity shares, if you're paying any interest for that, you can claim that interest as deduction, subject to maximum of 20% of dividend. Okay, so actual interest or 20% of dividend, whichever is lower, only that can be claimed as deduction. That is one such amendment that has happened here. Also, because now dividend is getting taxed, they have reintroduced few sections in your TDS provisions. So 194, that is TDS on dividend, and another section which is TDS by mutual funds on giving up the dividend, that is also now come in picture. I'll see that with the TDS provisions. But for now, remember, dividend is fully taxable. No DDT for companies. Same treatment if it is foreign dividend, deemed dividend, or domestic dividend. Mutual fund dividend is also taxable. Only thing you can claim is interest, and that to maximum is 20% of dividend income. That is with regard to your income from other sources. As far as deductions are concerned, deductions under Chapter 6A, there are two major amendments here. One is with regard to ATEEA, deduction in respect of interest or loan on residential house property. So if you all can, here the condition is the same. The stamp duty value should be less than 45 lakhs. They should not own any other house on the date of loan, and they should not be eligible to claim ATEE, the earlier section which we had. The only change that has come here is the period is extended. So now you can obtain loan till 31st March 2020. Guys, am I audible? Not audible, is it? Is it fine now? Better now. Fine, let's continue. So this period has been 2021. Same. Is still there. EA. Dot so you must be the amendment here. without qualifying. So if there are 4 categories as far as ATG is concerned, yes, 100% without any qualifying limit, 50% without any qualifying limit, 100% qualifying limit. Also, no, based on the statement which is filed by the donee, okay, not the one who is receiving the donation. They should file a statement. Based on that statement, they will be getting deduction. This is about your ATG. ATGGA. So any kind of donation made with regard to your scientific research and rural development. So basically, for having if Pgp, yes, that section. So here again, if there is cash donation, only up to rupees 2,000 of cash donation will be allowed from 1/6/2020. Earlier, the limit was 10,000. Now they have modified. So both the donations, now uniform limit of 2,000 is there. So 2,000 and more than 2,000, only non-cash donations would be permitted as deduction. This is the amendment as far as your deductions are concerned. Now, this is the highlight of your entire amendment, 115 back. There have also been 115 BAA, BAB, but that is not applicable to you. That is only for final level of portions. The tax rating choice given individual and HUF. Okay, up to 2,50,000, it is nil. There is no age criteria here. It is uniform for everyone. 2,50,000 to 5 lakh, it is 5%. 5 to 7.5, 10. 7.5 to 10, it is 15. 10 to 12.5, 20. 12.5 to 15, 25. And more than 15 lakhs, it is 30%. So basically, at every 2.5 lakh, there is a 5% increase of tax rate. Maximum is 15. There we had a maximum of 10. Here it is 15. Please remember, assessees, they have a choice to choose between this or your normal regular tax system. If anyone is opting for 115 BAC, they have to let go of these deductions or exemptions. Okay, what are these? Let's understand one by one. 10.5, leave travel concession. They will not get that. HRA, not allowed. Special allowances of 10.14, not allowed. Only few prescribed ones are allowed. Okay, in 10.14 section, they have prescribed 3 or 4. Only those you can take, others, no, not allowed even here. 10.17, your daily allowance or constituency allowance for MPs and MLAs. That is also not allowed. 10.32, minor child exemption, that is 1,500 every minor child which they used to enjoy, again not allowed here. 10AA, 10AA, that is tax holiday for SEZ, again not allowed if you're coming for 115 back. All 16 deductions, that is your standard deduction of salary, 16.1, 50,000, entertainment allowance which was given to government employees up to maximum of 5,000, or professional tax based on what amount is being paid, not allowed here. 24B, interest on loan for self-occupied. Please remember, only self-occupied property, not allowed. Additional depreciation, which means normal depreciation is allowed. Additional depreciation, the enhanced rate of 20% or additional depreciation which was given, not allowed. Scientific research donations which you were enjoying earlier or contributions to specific ones, they will not be allowed here. 3580 deductions, not allowed to those specified business. We even saw there, it has now become optional. 35CCC, deduction for notified agricultural extension projects. That is also not given. 57.2A, family pension reduction, that is the 1/3 amount, maximum amount, all that will not be allowed. Chapter 6A, from ATC to ATU, not allowed. So all your LIC, all this up to 1,50,000, which was earlier given, it is not allowed. Only thing which will be given would be NPS as mentioned under your ATCCD 2 and employment of new employees, ATJJAA. Okay, so the new employee deductible under ATJJAA and the National Pension Scheme, National Pension Amount Contribution under ATCCD 2. Only those two deductions are eligible. Other than that, none of the deductions of Chapter 6A will be applicable. So all this is taken away from you. All this is taken away. And the only thing that they're giving is new rates. Therefore, they give an option. Either you choose this or choose that. You must be wondering, who will even choose this one? There are so much of deductions that are taken away. That's why it's an optional amount. Okay? If anyone is doing a small business or if anyone is getting a huge salary, this might be beneficial for them. Basically, if they are having income in the bracket of, say, about 7.5 lakhs to 12 lakhs range, that income group might be benefiting it. You have to compare with their other incomes to other investments too. There are certain rules even here. If because of these deductions, okay, this deductions and the early deductions which we saw, if because of these deductions, you are having losses under any of the heads or depreciation, that will not be allowed to be carried forward or set off under 115 back. Okay, so if depreciation or loss was attributable because of these deductions, that will not be now set off against this thing. Any house property loss of the current year under 115 back cannot be set off under any other head. You have to carry it forward and set off only against house property income. Even current year house property loss, that will not be set off, and no limit here, like 2 lakhs of limit you have under the normal scheme, no such limit is there here. Maximum depreciation is now restricted to 40% rate. So rate of depreciation maximum is 40% under all the blocks. Sorry, I'm not getting the doubt. If anyone is asking. Yes? Was there any doubt here? Okay, so this is as far as your 115 back is concerned. Please remember your questions will specify very clearly whether the assessee is opting for the scheme or not. Also, they will specify whether you have to drop a comparison. In case your question is silent, and it does not mention anything about whether the assessee is choosing or not, and it happens to be a descriptive type, you have to work both the ways and say which is beneficial. Yes, you will have to work both the ways and say which is beneficial. Now, we are going to bifurcate into two categories of income. If the assessee is having PGBP income, then he can opt for this particular scheme, but opt out only once. That is, once if he is chosen, once if he is opted for the scheme, he can only one time opt out of this scheme. Re-entry is not permitted as long as he is having PGBP income. If in future he is not having PGBP income, he can again take a re-entry. But as long as PGBP income is concerned, if an assessee is choosing one time to choose this particular option, he can only opt out once. One time, he'll be given the option to come out of this regime back to the normal regime. But later on, he will not be given an entry as long as PGBP income is there. If he is having income other than PGBP, then that is salary income, interest income, house property income, can be any other income other than your PGBP income. Then he can opt in and opt out on year-to-year basis. So every year he can choose which is beneficial for him and he can opt in and opt out if he is having other than PGBP income. Please remember, This choice has to be made before filing return of income. Yes. What are the consequences in case there is any failure to satisfy the conditions? So the conditions are that you cannot claim deductions and the opting in and opting out. In case PGPP income is existing and this option is taken, then this option will become invalid. Okay. So for that particular relevant assessment year, this option will become invalid. Also for all the subsequent assessment years, if the person is chosen this 115 back, it will become invalid. So the assessing officer will have to assess the income and tax it under the normal regime only. If you're not satisfying the conditions of carry forwarding the losses or taking into account the deductions and exemptions that is being mentioned. If there is any other income other than PGPP, then only that particular 1 year where you have not satisfied the condition, only that relevant year will become invalid. Only that particular year they will calculate in the normal tax regime. Also remember, the alternate minimum tax under 115 JC will not be applicable to those people who are opting for 115 back, because even that is about not giving up the benefits. So here, if a person is choosing 115 back, please remember there are so many things that you have to take into account. First, the list of deductions which we saw, they cannot take that. Second, you have to see if they're having PGPP income or not. If they're having PGPP income, they can only one time opt out of this scheme if they have chosen. And again, no re-entry is allowed. PGPP income, if it is not there, that is salary income, interest income, year-on-year basis, they can choose to opt in and opt out. In case your exam is silent on the kind of regime the person is chosen, you will have to do both the ways, normal regime as well as 115 back. Please remember the back rates too. TDS have seen a whole host of amendments, okay? Because of this COVID pandemic, people were having a lot of liquidity issues, yes? The money was not being received by the supplier, by the customer. So they said, okay, I have a doubt here being asked if it's a combination of PGPP income and non-PGPP income, we will take it as if PGPP only. So if the assessee is having any amount of PGPP income, then you would have to go by the PGPP rules only. Yes, it is not income-wise, it is assessee-wise. Please remember this tax regime is not income-wise, it is assessee-wise. So it is not income. If the individual has any amount of PGPP income, then you go by this calculations. If the individual have income only other than PGPP, you go by this method. All right. So TDS amendments, because of this COVID scenario, in order to help people with liquidity issues, okay, they have given a new calculation for us, you know, adding on to our complexity. What they said, if in case TDS is to be deducted in this particular zone, 14th May 2020 to 31st March 2021, if any TDS has to be deducted, then only 75% of the existing rate will have to be chosen. That is, if the rate of the provision is 10%, 75% of it, 7.5%, if you deduct, it is enough. So 2.5%, they have added into the liquidity quotient of that particular person. This is applicable for all these sections, okay? Your 193, 194, dividend 194A, C, D, D, A. EE, GH, IA, IB, IC, JK, LA, NO. All of these sections. So basically the sections which are not there would be 192, 194N. Yes, those are predominantly the sections where this is not come. Please remember for your calculation purposes also, they will specify the date 14th May 2020. You have to remember as far as your TDS is concerned. Okay. Earlier, we used to have in 194C and 194J and all these sections, the audit used to be mentioned. Okay, they used to mention in the previous year if the assessee, individual and HUF, if they are subject to audit. Instead of audit now, they have amended it to turnover criteria. So if they had a turnover of 100 lakhs for business and 50 lakhs for profession, so they have changed that audit criteria to turnover criteria. Because audit has now become a little complicated, they have added up the turnover criteria here. So in case the assessee, this is with regard to your individual and HUF, if they were having a turnover of 100 lakhs for business and 50 lakhs for profession during the financial year immediately preceding the previous year, then they will have to deduct tax. This was that. Audit condition is now replaced with the turnover condition. Okay. As I said, new section of the on dividend is now come 194. So here the company will have to deduct tax at 10%. Please remember, I'm only talking about the broad rate. 75% on 194 will apply. This is applicable for all the sections that we will see, except I think 194N here. So I'm only going to talk about the base rate. Do apply the 75% based on the date criteria. Okay. So principal officer of the domestic company, they have to deduct a 10% before any kind of payment is made to the shareholders. It will not be applicable to individuals. Okay. If suppose the individual is a shareholder, then if you are paying to them other than cash and the amount is not exceeding 5,000 during the entire financial year, the aggregate amount again. Sometimes what happens is companies have a habit of giving interim dividend and final dividend. So they say take up the total amount of dividend during the year. If that amount is not exceeding 5,000 rupees, no TDS. If it is exceeding 5,000, deduct a 10%. And it is the obligation of the principal officer of the company. Dividend need not be deducted if it is given to LIC or to General Insurance Corporation or their subsidiaries or any other insurers, if they are the shareholders or if they are the beneficial shareholders too. This is as far as dividend is concerned. We understand why dividend is now being subject to TDS because it is fully taxable. Earlier, it was exempt, so therefore there was no question about deducting tax on it. Since now dividend is getting taxed fully, TDS is also reintroduced. Under 194C, that is contract, the change that has happened is with regard to your works contract definition. Here, this is an addition added. This is an addition which is being made. In case the manufacturer or the supplier, if he is customizing according to the specification of the customer and the material is being given by the customer itself or the associate of the customer, then even in that case, TDS has to be deducted. What is this? Say, for example, X is going to Y and saying them to customize something. Okay, say, for example, based on their requirements, they're asking them to do a particular contract or a job. And X is only supplying the material to Y. So in this case, TDS will be applicable. Or if any relative or associate of X, say Mrs. X is supplying the material to Y, even in this case, TDS will be applicable. Okay. So 48(2)(b is where you have to see the relevance of your associate, the same relative category. So in case if a person is supplying them the material or the material is supplied by its associate or relative, then in that case also TDS will be applicable. Regular sale TDS is not applicable, but because it is customization and material is supplied, then TDS will be applicable. Okay, a few doubts, I'll stick on to the later ones. Okay, I'll just come later on and I'll help you with those doubts. Professional fees, there have been a few rate amendments. It is 2% in case of technical services and 2% for royalty for sale, distribution and exhibition of cinematographic films. For everything else, it is 10%. So there has been a rate revision. Please remember 2% for technical services, 2% for royalty, and 10% for every other case. 194K is in respect of units. So as you all know now, even anything which is given by the mutual fund, so all the dividends given by the mutual fund is also taxable. So even they, that is the mutual fund company and those AMCs companies, those specified companies, they will also have to deduct a 10% if the payment or credit exceeds 5,000. This is other than capital gains. Okay, so capital gains, no deduction. It is on the dividend that deductions will be done. This is as far as unit is concerned. 194 is as far as your dividend is concerned on equity shares. Yes. (194N). This was introduced last before year. So what was happening here was, if there is any cash withdrawal in excess of 1 crore, that was getting subject to tax. So if a bank, cooperative society, or a post office, if they are paying, basically if the assessee is getting more than 1 crore from them, then that excess portion, more than 1 crore, was subject to tax at 2% at the time of making such payment. So up till 1 crore, there was no TDS. More than that, it would be 2%. But now what is happening? From 1/7/2020, you have to check on to additional criteria. That is, the one who is withdrawing cash, has he furnished his return of income to the tax authorities for the last 3 AYs, okay, for which time limit has expired. So for all the last 3 years, if he is not furnished return, please remember all the 3 years, all the 3 last years for which time limit of filing of return is expired. If he is still not furnished returns, then we will have different threshold and rate. The threshold shall become 20 lakhs instead of 1 crore. They said, so basically the argument of the income tax authority is, if you have not furnished your income tax return, how are you having so much of cash withdrawals of more than 20 lakhs and 1 crore? So they say, if you have cash withdrawals of up to 20 lakhs, no problem, no TDS. More than that, we will deduct a 2% till 1 crore. And if the cash withdrawals are exceeding 1 crore, 5% will be the rate. Please remember, this additional condition of threshold and rate is only applicable to those who have not filed their return of income for the last 3 years, for which time limit has expired. Okay. Other than that, the other rules of 194N stays intact. So if you all remember, it is for the single account of a particular bank. Okay, so if they're having in different banks, different banking companies, every banking company has to check on to this 1 crore criteria. So what has happened is, from 1/7/2020, we have to check whether they have furnished returns or not. So in case they have not furnished the returns, then the threshold will become 20 lakhs. So as soon as the cash withdrawal exceeds 20 lakhs, TDS will start applying. 20 lakhs to 1 crore, it will be 2%. More than 1 crore, it is going to be 5%. Let's take up a small example here. I think this is from your RTP question. Dr. Sargun maintained 2 bank accounts, one account with Canara Bank, that is current account, and a savings bank account with State Bank of India. The following are the details of a withdrawal made from these accounts during the previous year 2021. They've given us the date along with the amount for the particular banks. She furnished her return of income for AY 2021 and 1920 or before the time limit prescribed under section 139(1). However, for 1819 and 1718, she has furnished her return belatedly, but she's still furnished. Okay, time limit has not expired. Is there any tax deduction at source under section 194N on the withdrawals made by Dr. Sargun from Canara Bank and SBI Bank? If yes, at what rate and what amount? So I've just totaled it up for you. Total Canara Bank withdrawal is 1,20,20,000 and total SBI withdrawal is 45,63,000. We have to choose one of these options. It's again an MCQ question. Which one is most appropriate? TDS on 3379 at 5% by Canara Bank and no tax deduction by SBI. TDS at 2020 at 5% by Canara Bank and no tax deduction by SBI. TDS at 20,20,000 at 2% by Canara Bank and no tax deduction by SBI. TDS at 75 lakhs at 5%, 20,20,000 at 2% by Canara Bank and tax deducted at source, and TDS at 5% on 25,63,000 by SBI. Which is the most appropriate answers? Guys, please mention in the chat box your answer. Quickly. Yes, please remember she has furnished her return of income, even if it is belatedly, she has filed it. It is okay. So therefore, we are not going to take up the enhanced rates. The rates which we will take will be the regular rate only and the regular threshold only. Regular threshold is 1 crore. Since this is not exceeding 1 crore, SBI will have no TDS. And only the excess amount, since this is exceeding 1 crore, the excess amount is 20,20,000. Only the excess amount will be subject to TDS at the regular rate, which is 2%. So option C. Those who have answered option C, you're correct. TDS at 20,20,000 at 2% will be applicable. Yes, this is the kind of MCQs you can expect in the exams too. Let me move on to the next amendment. This is a new section which is introduced from 1/10/2020. Okay, 1/10/2020. This is payment by e-commerce operator to e-commerce participant. So who is an e-commerce operator? Amazon would be the best example that I can give you. Amazon is an e-commerce operator. Who is the e-commerce participant? Any supplier who is registered with Amazon would become the e-commerce participant. So normally what happens is when we buy online, we pay to Amazon. Amazon in turn would pay to the supplier. Okay. So when this payment is done by Amazon to the supplier, TDS will be applicable. At what rate? 1% of the gross amount. Okay. It could be for sale or service or both together. Again, at the time of payment or credit, whichever is earlier. And if it is an individual or HUF who is the supplier who is registered with Amazon, threshold for them is 5 lakhs. So if it is only 5 lakhs, no TDS will be applicable. And please remember, they have to furnish PAN. The individual and HUF, they also have to furnish PAN. Direct payment to the participant will also be taken as deemed credit. What is this? Suppose X is buying from Amazon. Amazon is in turn giving to the supplier. This is called as one amount. This channel would be subject to TDS. There would be sometimes the gateways are so arranged that X can directly give the money to the supplier. In that case also, since the facility was offered by the e-commerce provider or e-commerce operator, even this amount will be taken as deemed credit and also will be subject to TDS. So for calculating this threshold, this limit is also to be taken into account. So 1% is the limit here. If PAN is not furnished, the rate is 5%. Normally, 206 AA says in any of the sections, if the PAN is not given by the deductee, then you take up 20%. Only for 194O, it is 5%. Expect an MCQ even here to confuse you all. 5% in case there is no PAN furnished, not 20%. In any other section, any other provision, it is 20%. Only for 194O, they have said it is 5%. Let's take up this example. This is a very tricky one. Let's try and do this. TPR & Co., a partnership firm selling its product X through the digital facility provided by MKY Limited, an e-commerce operator. MKY Limited has credited in its books of accounts the account of TPR & Co. on 31st January. So it is after 1/10/2020. On 31st January 2021, a sum of rupees 4,80,000 for the sale of product X made during the month of January 2021. Out of 4,80,000, it made a payment of 4,300,000 on 3rd February 2021. Further, Mr. Pawan, who purchased product X through the facility provided by MKY Limited, has made the payment of rupees 40,000 directly to TPR & Co. on 15th January 2021. Which statement is correct regarding the requirement of deduction of tax at source by MKY Limited? No tax is required to be deducted at source. MKY is required to deduct TDS of 4,800 under 194C, 3,900 under 194O, or 5,200 under 194O. Please try and do it along with me, or if you can even send in your answers in the chat box. What has happened here? 4,80,000 is the credit happened. So we go by payment or credit, whichever is earlier. Since this is earlier than the payment, we'll take a sum of 4,80,000. 4,80,000 is the amount of credit happening here. And 40,000 is directly paid by the customer. This will also be taken as deemed credit. So let's take 40,000. 5,20,000. So this amount is exceeding 5 lakhs. Once it is exceeding 5 lakhs, okay, once it is exceeding 5 lakhs, TDS will be applicable. Please remember, this is only happen. This is a sale. This is a sale. It is not a contract. So B will not be applicable. The ones who have answered B, this is the reason why 194C will not be applicable. Okay. Because it is not in the nature of contract. It is in the nature of sale. So it has to be between C and D. Now, technically, the rate is 1%. So what should be the answer? It is 1% of, yes, what should be the answer? 5,20,000 into 1%, which is 5,200. Normally, this would have been the answer, but you guys have to also answer the COVID scenario, which means Is it happening after 14th May 2020 and till 31st March 2021? Yes, it is that period. So you have to apply only 75% of this rate. So that means 75% of the amount will come to 3,900. So the correct option would be option C. Guys, please understand, it is a little complicated for you all because of this COVID scenario. You have to apply even that. Okay. Normally, it would have been only 5,200, but we also have to apply the 75% criteria. So it becomes 3,900 under section 194O. I hope I have made this one clear. The next is with regard to your TCS amendments. Even here, we have a whole host of amendments which has come in picture. Same date, 14/5/2020 to 31/3/2020, 75% would be applicable for all except for alcoholic liquor. They say if people can pay for alcohol, they can also pay for income tax. So no reduction of rate here. Everywhere else, there is a reduction of rate. And if you see, it is 75% of the TCS rate only. Now, if you all recall, we have TCS in 4 categories. That was the category 1. Category 2 is on lease or license of parking lot, toll plaza, mine, quarry, etc. This is also reduced from 2 to 1.5 for this particular date criteria. Again, the 75% will apply here. Even for sale of, this is category 2. Category 3 is for sale of motor vehicle. If it is exceeding 10 lakhs, then from 1% to 0.75% from 14th May to March 31st. This is also 75% applicable for the same date criteria. Second category, third category. Now they have introduced 2 more sections in TCS. This is category 4 and 5. Let's understand one by one. 206C1G. This is with regard to overseas remittance or an overseas store package from 1/10/2020. So if there is overseas store package, so if anyone is paying to go outside for travel purposes, they will have to also pay, in addition to the normal tour package rate, they have to also pay 5% of TCS. Please remember, it is collected. So you have to pay not just for this, also for, so the tour operator have to collect not only his fees, but also 5% towards the TCS. There is no threshold as far as overseas tour package is concerned. The government argues if you can spend for a leisure tour outside, you can also spend for 5% here on TCS. Basically, it's an income check here. In case you are remitting it, remittance is when you're making a payment to someone outside India. In case you're remitting to any person outside India, then we check 7 lakh as the threshold limit. Okay, so up to 7 lakh, there is no TDS. More than 7 lakh, if you are remitting, then you also have to collect 5% of the amount. So in case you're remitting to any percentage, TCS at 5% over and above 7 lakhs will be applicable. The only exception here is if it is for the purpose of any education. Okay, so if loan is obtained from a financial institution and remittance is made for the purpose of education, then it will be 0.5% of the aggregate amount in excess of 7 lakh. Instead of 5%, it could be 0.5%. Up to 7 lakh, there is no TCS here. More than that, 0.5%. If it is for education purpose, if it is for any other purpose, it would be 5%. And if it is for tour package, no such threshold applies. This is from 1/10/2020 onwards. The next one is 206C1H. This section kind of had a huge impact in the business community. So when this was introduced in October 2020, it came up with a total different rule. They said if a person is selling goods exceeding rupees 50 lakhs to a single person, okay? So if X is selling goods to Y and the sale value is exceeding 50 lakhs, X can sell to many people, but every person or every place he has to check what is the total amount of sales. If it is exceeding 50 lakhs, then 0.1% would be the rate. Not 1%, 0.1%. And the reduced rate would be 0.07%. Out of habit, you will write 0.75%, and that would be wrong. It is 0.075%. Please be very careful here. For the period till 31st March 2020, as it was introduced in 1st October, which is after your 14th May date. So from the rate of introduction till 31st March, you have this rate only. 0.1% is the actual rate, but because of this COVID provision, it is 0.075%. What does this section say? It says if you are receiving, if the consideration is more than 50 lakhs, then along with the consideration, you also collect 0.1% of TCS. Okay? Please remember, when you're calculating this consideration, don't take into account exported goods or goods which are covered by any other TCS sections. You have tendu leaves, parking lot, or car. They are covered under different sections. Or where TDS is applicable, go to those relevant provisions. This is applicable for every other sale only. In case the customer is not furnishing PAN or Aadhaar, then collect higher of twice the specified rate or 1%. So definitely it will be higher rate of 1%, which will apply. So TCS will be collected at 1% or twice the specified rate. Please remember, this is only in case the consideration of sale received during the year is exceeding 50 lakhs. Yes, so along with this consideration, you will also have to collect 0.1% of TCS too. This is as far as your TCS is concerned. Please remember, 20% is the PAN criteria for every section except where they specifically mentioned. Like for example, under 194O, they have clearly given that it would be 5% if PAN is not furnished. For your supplier section TCS, they have clearly mentioned it would be higher of 1% or twice the rate. So on those sections, we will not apply 20% criteria. Yes, I hope that's clear now. That is as far as your TDS and TCS is concerned. Let's move on to the return chapter. Here only one small amendment. We all saw due date amendment, right? So due date, I said you, is 31st October. Date of furnishing audit report is 30th September. Earlier, only the working partner had this luxury of taking up the extended date of 31st October. Now they say every partner of a firm whose accounts are subject to audit, even for them, the due date will be 31st October only. Okay. So every partner of a firm whose accounts are to be audited, for them, the due date would be 31st October only. So 31st October will be the date applicable here. This is as far as return of income is concerned. That is the only one small bit of amendment that has come here. Yes, so those were the amendments that we have seen. Now, please remember, anyone who is writing in the May 2021, be very careful about all these amendments. Please go through your RTPs thoroughly. RTPs and MCQs. Even ICAI has come up with a whole bunch of MCQs for you all. It's available in the website of income tax, of ICAI. Please work out every problem from there. Go through your RTP thoroughly, go to the mock test questions given there, and also your MCQ, which is given there. If anyone has any questions with regard to the amendments which we have done today, Please post them in the chat box, or you can even ask here. If you want me to explain any particular provision again, I can also do that now. Can I repeat ATG? Yes, I'll do that. As far as ATG is concerned, PM Care is the new fund which is added. Okay, please remember PM Cares was not in the earlier list of funds that you had. You had other funds, but PM Cares is now made an addition to the 100% deduction qualifying limit without any qualifying limit. So whatever is the amount of PM Cares donation given, you can give them 100% of deduction when you're computing your ATG deduction. Also remember, now deduction will be allowed only based on the statement filed by the donor, which means anyone who is, because, yes, I'll explain 1 second. I'll just explain one by one. So what happened is donee, the one who is receiving donation, he is now subject to file a statement. So he has to particularly file a statement. Based on that statement, deduction will be given. It is just like your TDS, you know, we usually file a return. Whoever is collected TDS, TCS, or whoever is deducted TDS, they have to file a return based on that. Similarly, this will also work now. So donation will only be given based on the statement filed by the donor. ATGGA, I said you this is a parallel section of 35. So any kind of donation given for scientific research and development purposes. Now the cash limit, the cash donation, if it is only less than rupees 2,000, if it is only less than rupees 2,000, that would be given as deduction. Earlier, this limit was 10,000 here. ATG limit was 2,000. ATGGA was 10,000. Now it has become uniform 2,000. Okay, that is with regard to your ATGGA. Yes, I will be circulating this PPT in the group. Also, you want the 5 crore amendment of PGBP. So now please remember there are 3 kinds of threshold or limit, audit limit. 5 crores, if assessee can make sure that the cash receipts are less than 5% of the total receipts and the cash payment is less than 5% of the total payment, then for them, only for those people, 5 crore limit of turnover or gross receipts will apply. Please remember it is only for business, not for profession. For profession, your 50 lakhs criteria will still be applying only. Okay, fine. You're not able to fit in that 5 crore limit, then come down. Can you make a choice of 44AD? If you're able to choose 44AD, 2 crore limit will apply to you. If you're not, that is, if your turnover is less than 2 crore, you need not get your books audited. Okay, you're not even able to manage 44AD. In that case, if your turnover is exceeding 1 crore, you have to get your books audited. This is your 5 crore criteria. Yes, I hope this was understood now. For 5 crore, you have to fulfill both of these conditions, okay? For 2 crores, it's only about 44AD option. If you're choosing it, the turnover criteria is 2 crores. And if you're not opting for it, then 1 crore, more than 1 crore, you have to get your books audited. Total aggregate of turnover and gross receipts. If any other doubt, please let me know. I'm here for you. Please give a special focus and attention to your amendments. For sure, you can expect 15 to 20% of questions picked out of this. And especially this year, you have a lot of amendments, a lot of complexities. So for sure, it will be asked. TDS, be very careful with regard to 75% applicability. ATEEA again. It's only about 2,000 rupees cash donation. That's all. Okay, ATEEA, sorry. I thought GG. For ATEEA, in respect of loan of residential house property, the only change is happening here is with regard to your extension of date. This was 31st March 2020. This is now extended to 31st March 2021. This is the only change which is happening here. The limit amount of 1,50,000 is the same. Also remember, this is over and above 24B. The only change is this is extended. What is extended is loan. Loan sanction date is extended. If you have any other doubt, guys, please let me know. Yes, I will be circulating this one in the group. Not immediately, okay? By evening, I'll be submitting in the group. If you guys have any doubt, let me know. Otherwise, we'll wrap up the session, guys. All the best. Yes, thank you all for joining in. I had a good time with you all, explaining it to you. All the best, everyone. Do well. If you have any doubt, you can also WhatsApp me, but I will reply at my luxury only.